Welcome to episode 62 of Accessible Finance. I'm Eric Johns.
I'm Rachel John.
What?
We are going to continue with our real life scenarios from people who just want help.
Hopefully this is useful to you guys. Let us know.
Yes. All right. So, Eric, this is a very specific one. Some of the ones we've done previously required a lot more information. This person gave us all the information.
That's pretty good.
All right.
That helps. Let's see what we got.
So there's going to be a lot of numbers, a lot of things to follow.
Okay.
So write down the notes as you need.
Yes, ma'am.
All right. Need advice.
Yep.
Retiring in 4 years.
Okay.
With a $6,000 a month pension and $2,500 in Social Security. So we're talking $8,500 a month.
Okay.
I currently own 2 homes. One is worth $1 million. It is a seasonal rental that pulls $20,000 annually with no mortgage.
Okay.
The other is worth $1.2 million with a $300,000 mortgage.
Okay.
Total property taxes are $28,000.
Okay. What was the second amount? Sorry, I'm going to forget.
The second amount of the house or the mortgage?
The $20,000 annually, and then the second property generated what annually?
The second property did not generate anything as their primary home.
Got it.
They do have a $300,000 mortgage.
Got it.
So total property taxes are $28,000. So if you offset that essentially with the 20,
Okay.
you're at 8. I have $700,000 total in a 403B
Okay.
and various stocks, with a 20% return.
She's 403B in various stocks or
And various stocks.
We're assuming that's outside of the 403B?
I would assume so.
Okay.
$700,000 total, comprised of the 403B and the stocks.
Plus the stocks. Got it.
Correct. I inherited an annuity worth $100,000, which I must deplete in 9 years.
Got it.
My salary is $150,000.
Got it.
However, I have an $85,000 HELOC with 8% interest.
This is just like hilariously detailed.
It is.
With how much? 8%?
8% interest.
Okay.
A $600 a month payment.
Okay.
And I have a $660 a month car lease payment, which I do plan to buy at the end.
Okay.
My only other debt is $9,000 in credit card, which I am working to pay down.
That's okay.
My question.
Okay.
Should I deplete the annuity now, right? He's got the 100K. Should I deplete the annuity now, take the tax hit, and pay off the HELOC? Or should I take $52,000 from the annuity and buy out the lease now? Then take the payment I'm no longer paying and put it towards my Roth IRA or my 403B, which I'm currently not contributing to, or any other ideas. I really hate making a $1,200 a month in payments when I have the money to pay them off.
Okay.
Now, I am not a CFP.
Okay.
My initial gut instinct says,
let's see what you got. This could be really fun, guys. Hey, we're in.
Okay,
Let's
no,
go.
I only have one thing. And it's not very impressive.
Let's hear it.
But my initial instinct is, why are we not talking about paying off the credit card?
Well, we are.
Paying off the credit. Well,
You're talking
this
about
person
how
is
I
not. So my initial,
the either or was kind of interesting. Like, what a weird false dichotomy there. Like,
Yeah.
why do you have to do just the HELOC or just the auto or what?
Well, it was just the HELOC or paying down the car,
lease.
and then instead of the lease, contributing to a Roth or 403B.
Got it. Yeah. So then we just leave the HELOC in this case.
Correct. And so the
That's in the
HELOC's at
auto
8%. But my gut reaction is that your credit card rate is probably higher than that.
8. No, 100%. Absolutely. Good call.
And
Very good call.
Low-hanging fruit, right? We're talking $9,000.
Right.
So we have no business
You're
holding out a credit.
correct. Absolutely agree. 100% agree.
Okay.
That's the FP designation. Not too far from your reach, huh?
Yeah, no.
Well done.
No.
Fantastic work.
I appreciate.
Let's talk about it.
No. That's all you want to talk about. No, but there's a
Great plan.
No, but there's a lot going on here, and I think that it's interesting to me that this person started with only looking at the lever of the annuity, the inherited annuity. Right. Now, there are other things that we can do to use funds to fix some of the things that are feeling scratchy, right? But this person's come to us and said, my acute issue is I don't want to pay $1,200 a month. I have a credit card debt. I have a HELOC. And I also have this other mortgage. We don't know the interest rate on the mortgage. But like, I have this inherited annuity, fix the things.
Sure. So
Thoughts?
there was a lot of words and a lot of information given.
Yeah.
So good deal there. What do we know how old he or she is? You the guy?
It was a guy.
Okay.
He said he was retiring in 4 years.
Right.
So did not specify his age.
Okay. He could be 66. I mean, it could
Did
be
not
72 for all we
indicate
know.
anything in there about retiring early. So the people who were commenting all were commenting to like assuming that he's retiring at average like retirement
67,
age.
so they're
Exactly.
we're 63 or something.
Correct.
All right, sure. There's a lot. And the first thing I would say is this is one of the reasons you go to the planner. Like there's just, and this is just to go back to a couple episodes ago, we were talking about like, can a planner generate, actually, I guess it was last episode.
It was last episode.
Can a planner generate 1% on all of my assets in value, right?
Especially if you feel like you've grown those assets yourself, it's really hard, I think, to get over the hump or the idea of like, I built this, why am I paying you?
Right. And like humans are not terrible at math, right? If this guy has, the guy in this example has $700K, that's $7,000 a year that you're paying to a planner. And like, that's a 1% fee on $700,000 is $7,000 a year. That's a lot of money. And people are going to, I mean, there's a lot of people that don't want to pay $7,000 a year. And that's absolutely understandable. And in this kind of a situation, I would absolutely say this guy would get far more than 7K. Then there's so much to dive into here. There's so many questions that I would have for this individual, right? Like, how old are you? But there's just a lot. Like, how much of the 700K is a 403B versus stocks? Like, tons of information, and there's still so many questions.
Yes.
Right? Like, what's the inherited annuity invested in? What is liquidation like? I assume
what is his cash flow like, right? Like he's making $150,000.
Yeah, that's a fantastic place to start. You should have the designations.
No,
this is great.
But when I hear $150,000, right? We're not. That's not a small salary.
No.
And you have like the majority of your assets are in property, right? Correct. You have $2.3 million in property. So you've had enough at some point to be able to invest where a $1 million house has no mortgage. The 1.2 only has $300,000 in mortgage. You are very weighted there.
Yeah, net worth is pretty large.
Correct. So presumably you have had a cash flow situation that's been positive enough to support that.
Right.
So if you're getting $150,000 and we're believing that your expenses are relatively low, there's excess cash there which is probably being spent.
And likely going to have Social Security.
Right.
Significant Social Security.
RMDs.
Right. It depends. It really does depend on your age. Like, are we looking at your Social Security being cut by what is it, 30%? Or is it going to increase?
Well, I mean, so he said he's retiring with $6K a month in pension and $2,500 in Social Security. So he's already just determined that's what it is. But you're talking, what, $8,500 a month? That's not a small amount.
He's getting $2.5K from Social Security. Oh, I see. He's getting a pension as well. The 6K. Yeah, exactly. How much of your cash flows is $8,500 cover? I think that's a fantastic question. A great place to start.
I mean, so if you're making $150K in salary now, but you're making what, $102 in retirement just from your pension and Social Security?
Right.
Like,
how much do you actually need?
Exactly. You're not cutting it by all that much.
That's a really good question. I would want to know how much of the gains is trapped in the stock. Like, how likely are we to sell this stock within your lifetime? Like, is there a step up in basis? Do you have any estate planning considerations? Like, if this to people that a step up would matter, are you charitably inclined? Are you going to donate this to charity, or is your estate going to donate it to charity? Like we said, it's a single individual at 4 years from retirement. Maybe he or she is never getting married. And presumably we haven't talked about any kids or anything. So we can't really speculate there.
No, there was no mention about anything there.
Right. We don't need the HELOC. I want to know how liquid the stock account is, right? Like what's the basis? How much of a capital gains hit are we going to have to incur there? We're still under net investment income tax thresholds. If we were to sell the stock, so we're looking at 15% capital gains on the appreciation of the stocks that we're picking. I mean, why are we picking individual stocks? What's your risk tolerance like? There's so much, right?
There is.
There's so much. What is your income going to look like? When does a 6K a month pension kick in? What are the provisions there? Is it inflation adjusted? Probably not. Just
right. I would assume most would not be. Well, I think this is a prime example of I've given you all of the numbers, right? And that's great.
Yeah.
We haven't really gotten all the numbers, right?
Correct.
We don't know certain things.
It's very different.
But this is a really complex situation with so many levers that can be pushed and pulled. So much of this depends upon interest rates as well. We have the interest rate for the HELOC, but we don't have it for the mortgage. We don't have it for the credit card, right? We don't have it for various other.
The credit card we're assuming is super high. Mortgages we don't really know. The $20K annually that he's generating from this rental property, I'm interested if that even covers the mortgage that's there, right?
So there's
only the mortgage left on his primary residence?
There's no mortgage on the rental. So it's offsetting the property tax.
It's $1 million value, right?
Correct. It's $1 million house with no mortgage. It's $1 million with no mortgage. What, the $28K property tax on both?
No, the $20K annually generated on
agreed.
$1 million property. 2%, that's pretty low.
I got the feeling that it was more of like an Airbnb rather than like a permanent tenant.
Okay. I mean, even if that's true,
I imagine that
maybe sell it and go and.
I imagine it's probably used as a vacation house.
So one of my things that I'm thinking about is like his salary is $150K a year. He's above, even if he's an active participant in this real estate, he can't deduct any losses that he's generating there from depreciation or rental expenses. He can't deduct any of those from his ordinary income on his tax return. So that's not great to have it. Like maybe if it's not incredibly highly appreciated or he doesn't have other use for the property, he'd probably get out of it. But I mean, given that he's already paid the whole mortgage off, he's probably had it forever. His basis in the property might be, $500K or less, in which case we probably don't want to bite that, we won't want to take that big, huge tax hit. But there's a ton of considerations, and really we would need to know the individual to know where we're trying to go here. Like, is he going to retire in a low income state, or is he looking to like travel the world?
There was no specification about the state. It's tough because I think 77% of this person's net worth is tied up in real property.
Correct.
Right. So that's a huge risk.
Right.
We like to talk about diversification. It's not a very diversified investment. It's hard to argue with the numbers suggest that he's in great position, right? But there are definitely suboptimal things going on here. And so this is, I think, a prime example of as far as which fires to put out first, or which fires
let's address that, right? We can talk about that. Let's assume that he's got $150K salary, he's got positive cash flow, and maybe he didn't tell us his totality of his taxable accounts.
Okay.
I mean, he does have credit card debt, so maybe he is somehow in the hole. The credit card debt should be paid first.
Well, he says, I'm paying down.
If he is unable to pay the credit card debt out of his cash flow in the current month, like if he needs extra money to pay that thing now, I'm saying yes, take money out of your annuity and pay ordinary income tax on your annuity. I don't care if you're in the 24% tax bracket. We're going to take enough out of the annuity so that you can pay the 24% marginal tax on the annuity withdrawal, and we're going to pay down the credit card debt, period. That's going to happen first. Like I'm not going to earn whatever this annuity is generating, which is probably not that substantial, maybe 4%, and then I'm going to pay 20% in credit card debt, right? Like, and that's a pretty low credit card rate right now.
Exactly.
It's probably 28 or 24.
It's probably higher than your marginal.
Yeah, so that's nonsense. So you're paying off the credit card before you do anything else. The HELOC's 8%. That's the only one we really know. The auto loan's probably pretty high. We are definitely looking to get out of both of those.
Yeah, because he does not like paying, because he's paying $600 a month on the HELOC.
Yeah.
And $660 a month on the car lease payment.
Yeah, so
does not want to pay $1,200.
$1,260 a month. I don't blame.
Right. So then he is looking at either paying off the HELOC, right, or paying off the car loan and then using what that payment would be for some type of retirement account, right?
Correct.
So he's looking at paying down both of these like larger outstanding loans, while leaving this like $9,000 credit card, which in the big scheme of things is a pretty small amount and easy, I think, to pay off.
Right.
Just sitting there. I think that's an easy fix.
And look, I think the way you thought about it initially is perfect. I think that's exactly where we start. That was incredibly well done. I want to say it again. So like, no, we're talking, so what she said, right, was what Rachel said was the guy makes $150K.
Yeah.
And the guy's going to make in retirement, he's got a $6K a month pension plus $2.5K Social Security, $8.5K, $102,000 a year. That after taxes, that's probably close to what he's taking home now. Yeah. And he's accumulated significant assets. Yeah. His net worth, as you pointed out, is like close to $3 million, right? He has a $1 million house, 1.2 house, and $700K.
Exactly.
You add that up, that's 2.9. All right, so he's got almost $3 million net worth. So he's been netting positive. All we know is that he's probably been netting positive, unless he got huge inheritances somewhere, but one of them's a $100K annuity, so maybe not that huge.
Yeah, correct.
Point is, the guy's probably been positive cash flow for a while, meaning he's spent under this $150K, well under this $150K. If we assume like a 20% tax rate, effective tax rate on this guy, that's like $30K. So that means he's spending $120K.
Yeah.
You know what I mean? Or like he's doing something with the $120K. He's probably not spending that much. Point is, this guy got his cash flow probably well taken care of.
I would assume.
Unless he's got some individual considerations that we just don't know yet.
Correct.
So he might be wanting to spend more in retirement than he does.
To that end, I think we have personally seen with clients that we've worked with certain situations where somebody has the cash to be able to buy the things, but yet still uses the credit card because the emotional connection that you have to seeing that number of your cash is really, really hard to let go of.
Sure.
And so they would rather just pay the minimum balance on a credit card and see their bank account balance being bigger than take a larger hit and see it go down by 9K right now.
Please don't do that.
Yeah.
It's our job just to tell you, like,
to work on that emotion. Tough. It's tough. But, you know, based on what we have here, that would be my assumption.
Oh, that's good stuff. That's useful.
All right.
Did we answer his question?
Well, so the question was essentially like, should I deplete the annuity now and take the tax hit? His thought was, I either take the annuity to pay off the HELOC or take the 52 from the annuity instead of the whole annuity, right? 52, because that is presumably the value of what he has on the car.
The lease and purchase of the car.
Correct. And buy out the lease now.
Okay.
And then take the $6,600 a month he's paying on the car and instead contribute it towards his Roth.
So that the answer to the question, and like we said a lot here, is it depends.
Yeah.
What does it depends on? It really we're just looking to do the math on what his marginal effective tax rate is this year versus retirement. And then do that math with the 8% of the interest on the loan.
It's also important to note that those are not the only two options to do with the annuity.
No, correct. We're absolutely going with credit card first. So like basically both of your choices are, I mean, without being too rude, both of those choices are wrong. The first choice is withdraw from the annuity and pay the credit card, and then we'll talk.
Or if you have the cash, you do it. Don't withdraw from the annuity and pay off the credit card with what you have.
Well, we should be looking to pay. We agree with the premise of we're getting out of these debts at medium to high interest rates, right? Like 8% is not low, and we're not going to be generating more than that on a risk-free rate or a risk-free basis, right? So
exactly.
Yeah. So probably withdrawing at least some from the annuity if you can't fund it with tax flow, which we assume you're not. And then we're thinking about what your cash flow actually looks like to where your 105 is not sufficient, or 150 is not sufficient, given that, you know, you've got 102 that it's going to be incoming, and you probably have been saving a significant portion over time to reach the current financial status.
Correct. All right. We got one more. Are you ready? All right. The next one says, I recently met with my insurance agent at State Farm, who does investing on the side.
Okay, cool, great.
Okay. Does this raise any red flags for you?
I love it. Let's hear it.
All right. My husband is retired and collecting Social Security and has about $400,000 in previous employer's T Row price, which he can leave in as long as he wants. I am still working, and I have $350 in my 401k with T Row.
Okay.
I also have $64K with Edward Jones.
She said she had 400?
She is $350. He is $400.
Okay.
She's working. He is not. My husband has about $24,000 also sitting in a 2020 account with T Row Price. So presumably this is separate and apart from his 401k. The agent is really wanting my husband to take his money out of his 401k. So we're talking the $400,000. And invest in an annuity.
Great. Yeah, wonderful idea. Let's do it.
This makes me nervous. What should I do?
You should talk to
someone who's not your State Farm insurance agent.
Please go get a second opinion. Talk to somebody in your family that you think is good with money. Talk to.
Well, okay.
It's hard not to.
I think the first thing to do is really reflect back on the conversation we had in a previous episode about fee-based versus fee-only.
Yes, this agent stands to make a significant commission if he sells you this 400K annuity. He's heavily incentivized to do so. You or your husband may want an annuity. Okay, the annuities that we would typically recommend, what is the use case for an annuity? You are incredibly risk averse. Okay, incredibly risk averse. You have no estate goals. You have no children. You have nothing. You don't care what happens to anything that's yours right now when you're gone. That's pretty much it. So
that's an interesting fact that you brought up.
Okay.
This specific hypothetical in a later post in answering, because somebody had asked, what's your family situation?
Okay.
There are 2 children and 4 grandchildren.
Yeah, I can't imagine this. Okay. It's almost certainly not great, but even if you wanted, when we recommend annuities, it's very typically single premium immediate annuity. What that means is I hand you a large stack of cash, like in a check. Like obviously it's digital. I'm just kidding mostly, but I'm going to hand you a large check, a large payment, and you're going to hand me back payments for the rest of my life. That's the deal that we're making, and that's what we're doing. We're insuring against longevity, and we're doing it because we're super risk averse and we just want the payments. Okay. So that's the use cases, and that's the kind of annuity that we'd be looking to do. This does not sound like we're there yet. She's still working. So presumably you're still working. We're going to assume that you're not older than 70. Okay. And we're going to assume that if you're 70, you still got what, like 20 years left. We're going to assume 90 into plan. So here's a couple things, low hanging fruit. One is she talked about both of them being in T. Rowe Price. It's important to note that T. Rowe Price provides investment options within 401k plans. They are not a 401k plan. So she's in a 401k plan by previous employer, and he's in a 401k
by
plan.
current employer.
She's in current employer. He's in previous employer.
Correct. So he could
roll his into an IRA.
Correct.
And one of the things to note, right? So we talked to people about this a lot because there's a ton of confusion and just poor information around what can I do in 401k accounts? Do I just sit there? Is it good to just sit there? Almost never is the answer, yes, it's good to sit there. Okay, why is that? Because there is a non-zero cost to you to being in a 401k. So basically a 401k account gives you a curated menu of investment options. Let's call it 30, okay? So you have these 30 investment options. If you were to invest in if you have an IRA account, it's essentially like you have all of the investment options.
Everything.
So you have these 30 options plus literally infinite more, or the total. It's not infinite. It's the total number of market.
It's everything that exists.
Total market portfolio that exists for the United States market that's permissible for you to buy here.
So if you're in a 401k, you are paying essentially a premium for the person who curated these 30 options on your menu.
Exactly.
And you're continuing to pay that whether you're working with the company that has the 401k or not.
And the company has to pay somebody to administer the 401k. So basically a 401k will have a fee annually that is not $0. Okay. It can be very low. It might be $5. It might be $25, but it's not zero.
We've seen some that are low. We've also seen some that are very high.
Correct. There could be some that are north of 2%.
And almost every single time, the people that we have been speaking with have no clue what those charges are. They make it very hard. I was going to say, they make it hard to find.
for advisors sometimes to find these fees.
They make it very hard to find.
You have to go to the adoption agreement. Like it's frustrating to find these fees sometimes, right? Like the required disclosures will just, anyway.
It's very complicated.
It's hard to find the fees. 401k cannot be zero. IRA, always zero. Okay. Well, always zero if you don't have an advisor in the account system, right? But basically if you go to Schwab, Fidelity, Vanguard, IRA fees, $0. So is it possible to be lower than $0? No. So you should pretty much always do an IRA. All right, unless you're looking for ERISA protections, which means you're worried about, liability, right? Or you want to take distributions before age 59 and a half. Okay, so those are the two primary use cases. There are others, okay, and there's other ERISA protections that might be, viable for you. So talk to your financial professional. This is not financial advice. I'm telling you, always do this thing.
Correct.
But always consider this
thing. Exactly.
We'll say, okay. So anyway, 401ks will have a limited list of investment options. So unlimited is always better than limited, and no fees are better than some fees.
Sure.
Okay. That's it. That's what we're saying. So basically this guy, so for the husband, he can get out of this 401k.
Exactly.
And roll it into an IRA and then choose what he wants to do from there. Whether he works at State Farm or not, I would not. So I would do that.
Well, and I think what's challenging is that the State Farm agent is taking the most valuable of the monies that we're talking about and trying to tie that up into something very, very
and he's heavily incentivized to do so.
And I think that's what's challenging is that I don't think the majority of people realize just how much people who are selling annuities make. You've actually written a few articles on this that have been published in various things. You can actually check them out on the website if you're interested. But typically, annuity salespeople are making the entire first year of payments as
of
their
your premiums.
Correct. And so it's not a small amount.
Yeah, you might pay $1,000 a month or so.
If you're paying they're making 12.
Yeah.
They're making your entire first year. And then they'll continue sometimes making a portion of that.
Well, that's whole life, right? So annuities, your top two, we're not going to have a premium. They're going to have a substantial commission on that.
It's just, it's alarming. And I would be concerned that somebody whose primary goal is providing your insurance needs, right? So now they're a trusted person. Yeah. They're now trying to say, hey, on the side, not through my State Farm business, like on the side, I do this like investment thing. Mm-hmm. Get a second opinion. Because once you're in that annuity, and we've seen that, getting out is
unpleasant,
very difficult. Yep. And sometimes
there's surrender fees and
not ideal.
After like a 30-day look window, then it's really hard.
It's a lot. All right. But yeah, that kind of wraps up based on time. We do have quite a few more scenarios that we'll be talking about in our future episodes.
Hopefully this is helpful.
Yes, please let us know. And again, if you have your own scenario or question,
let us know.
Some of these are kids writing scenarios for their parents as they're entering retirement. We'll welcome that as well.
Absolutely.
All right, till next time.
Thanks, guys.